Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Lockheed Martin stock. This one's been up on the chalkboard for a while. It came in by request down in the comment section of one of my other videos, and I've had lots of requests in the past couple days for this one because it's fallen quite a bit. I'll look at that in just a second. As always, this is not individual investing advice. This is just how I analyze stocks. If you have a stock you want me to take a look at, put it down in the comments. I'll reply to you once I get it written up on the chalkboard, and eventually I'll get to it. I'm working through these really fast, but we're adding quite a few too. So yeah, keep asking for them if there's more you want me to look at. Okay, let's get into Lockheed. So I usually like to start by looking at the long-term earnings trajectory, and that's pretty good. So earnings have grown. Actually, let's shrink this down to this year. So these are going to basically be completed earnings. Earnings growth rate almost 11% over the past 20 years or so on average. That's pretty good, right? So an investor that bought 20 years ago, I don't know if this is going to have, I might need to move a little bit more. There we go. Get this full decline in here. Is it going to do it? Doesn't want to. Okay, maybe we'll refresh this and take a look. So an investor would have done pretty good. I'm just going to pick a random point and see if we can. There we go, 500 or 600% over the past like 20 years. So not too bad with the stock. I'll come back and look at this recession period in a little bit. Let's first kind of look more closely now. So I am long this stock. I don't remember if I may have even made a video back when I bought it. I probably did, because when I looked at my notes, I bought it on January 29th, 2021. And that was the one quarter where I was kind of fooling around with YouTube to see if it was something that I wanted to do. And I did it for like one quarter, and then I kind of took a break until October 2023. So like 2.5 year break, mostly off YouTube. So yeah, I might have an old video. I didn't check, but I bought it right here, according to my notes, and it's up about 50% since then too, because I managed to buy it during one of these kind of declines here. But it's been getting creamed lately off this little peak here, which only happened like 6 months ago. Stock's down 30%. So it's kind of worth asking. This is a good one to ask about, I think. It's a little tricky to kind of forecast what's going to happen, but I'm going to just put some numbers out there so we can at least look at the math and kind of see what it says. So I'm going to use these forward earnings that analysts think are going to be $27.21 a share. So I'm going to be pulling forward pretty much a whole year's worth of earnings. That's about this time of year is kind of when I start looking forward a year. So that's something to keep in consideration if they don't make those. Now, a lot of times with these defense contractors, analysts have a pretty good read on what kind of earnings are going to be over the next kind of year or two, because there's like contracts and stuff. That said, the new U.S. administration looks like they're going to be making some cuts. I saw one headline that was like looking at 8% defense cuts and then shifting a bunch of priorities and things. And so far what we've seen is they've done those changes other places. They're doing them really fast. And I think that's the panic on why the stock price has sold off. Now, it was trading at it kind of had gotten a bump here, like it kind of shot up basically going into the election. And then since then it's fallen. So I think that those risks are absolutely real. I also think they could be made up for by other countries. If the U.S. isn't going to help defend, the global trade regime that we have had in place for the past 60 or 70 years, then a lot of smaller countries are going to have to beef up their militaries. And for what it's worth, I think they should. So I think that even though the initial reaction could be an earnings hit to a company like Lockheed, that doesn't mean that there couldn't be other places that pick up the slack. So I'm really not, I wouldn't trade this one based on news. I personally, I own it. I'm not selling it. I also don't think it's a buy right now, and we'll get into the valuation. So let's do that. So what I'm going to do is I'm going to do the best I can to kind of forecast out if you bought the business based on the trends that we've had since 2016. And actually, I'm not, for my earnings growth rate that I'm using, I'm not looking forward next year. I'm not counting on that. So if you look at from this point to this point, and I actually calculate mine by myself, my own way, but they're exactly the same basically this time. So I'm just going to show you on the fast graph. Earnings growth during this time period was 7.68%. I'm going to use 7.7%. Expectation is for what I'm looking for over the next 10 years or however long it would take an investor to earn their money back. So we saw longer term, it was like what, 10 to 11% over the past couple decades. Of course, we've had wars and stuff during that time, so that could be a little higher. If we don't, and spending in this sort of area gets rolled back, obviously it could be lower, but this doesn't seem like an ambitious expectation, like 7.7%. Doesn't seem super ambitious. So I think that's a fair estimate to use, and it could be lower than that. It could be bigger than that, but we have to just kind of do what we can. I always try to base mine on history if I can. And so I'm just showing everybody this is basically the time period that I'm looking at to forecast forward. And then you just have to use your judgment whether you think that's a good method or not. So what I want to know is if I bought this business for whatever price is trading at, for whatever value what I pay for it, if I bought it for just $100, how long would it take those earnings for me to earn back $100 on my investment for every $100 that you invest? And what I want to, so I want to see how long it would take to earn that investment back with that 7.7% earnings growth rate expectation. So we go in here, we have the 7.7%. So that creates a PE ratio. I don't have the PE here. I have the earnings yield, which is inverted. So it's showing an 18 PE. Let's see what the earnings yield is. They have their earnings yield at 5.41%. Now this does pull forward those next year's earnings. So this is the base we're working with. But I'm basically right in line with the fast graph still. The earnings yield at 5.36%. So the earnings yield is the PE ratio inverted, so the earnings over the price. So it's exactly the same as the PE ratio, and I'm basically using the forward PE because I'm pulling forward this year's earnings. So the way to think about this is if you bought the whole business for $100, and they would earn $5.36 for every $100 that you paid for the company. That's with no growth, but we do expect over time, or I'm using 7.7% earnings. And I also, when I do this, I assume they'll grow 7.7% this year. So that's a little optimistic on the first year, I think, kind of on every front here, but not anything kind of crazy. Okay, so we have our earnings growth rate, and we have our earnings yield. So the first year we would earn $5.77. If you own the business, you could just keep that. And then the next year, if you grow 7.7% again, you would earn $6.22. Keep that. And what I want to know is how long it would take you to collect $100 on your $100 investment. So we can see here, actually, it's going to take about 12 years. That's what this 12 is. Now, right now, the S&P 500 average is about 15-year time until payback. So Lockheed is a little bit cheaper than the average market if these assumptions work out. If they really earn $27 this year, and if they can really grow earnings about 8% or so over time, over 12 years, then that 12 years is about how long it would take for you to earn your money back as like a business owner of the business. So usually I want that to be about 10 years before I buy, especially for an established company like Lockheed, and also one where the earnings are kind of going to be in flux probably for the next few years. So I have a few different potential buying prices to think about depending on how optimistic or pessimistic. Let's see, I think when I looked, I bought it at about $323 a share, but that was like 3 years ago, so maybe almost 4 years ago now, actually. It is 4 years. I can't believe it. I haven't really paid that much attention to this stock. That's a good thing, is once you buy one kind of like this and you pay a decent price, you just wait and see if it works out or not. Okay, so to get to 10-year time until payback was just my standard plain vanilla number. $348 a share is where Lockheed would have to fall to. This is assuming they hit these earnings this year. Another thing to think about is I'm kind of pulling forward a year. So that's more like 10, 11 time until payback, right? So a little bit more on the optimistic end. Now, as the year progresses, that doesn't really change. So I would still use the same method next October or whatever. I just thought I'd throw that out there a little bit. But I probably wouldn't pay more than like $350 for. You're not going to find too many people on YouTube that own stocks and tell you not to buy them yet, but I do it all the time because, look, most of the time, if you want to make better than average returns, you're going to have to pay a little bit cheaper than the market's willing to pay, because you want the market to pay more in the future, right? So it doesn't mean I know exactly what's going to happen with the stock price, but I can tell kind of when the probabilities are better, right? So, and I like the probabilities to be on my side. You can look like now the stock fell 30%. Well, I'm still up 50%. I hadn't even really looked at the stock very much. And that's just because I bought it when it was cheap, right? I bought it right there you can see it on the chart. That was the cheap, other than the 2020 crash. That was the cheapest it had been in 2 years, right? And it wouldn't be that cheap again. Well, it's still not that cheap, right? So if you can buy it on a good dip like that and pay a good price, the probability of you doing well is better even when things go poorly like they've gone this past year. So now after this decline, I haven't outperformed the S&P 500 with this, but those returns are pretty good. I mean, a 50% return in 4 years is not too bad for a stock that's struggling, basically. And that's what the margin of safety kind of does for you. So 348 is kind of that initial level. I would probably lean more toward the 9-year personally right now with the information that we have at the time. And so that time until payback is $301 a share. That would kind of be just the midpoint of where I think, is probably a good price, just given everything we know at the moment. But these things are changing pretty quickly, so we would have to wait and see. And then if we go back and look at the Great Recession, the stock really struggled, and the market wasn't really willing to pay very much for it. So you look at the PE ratio back during this time, and granted, I mean, you can understand it during 2008, maybe 2009, but you go all the way to 2012, and it's still trading at a 10 PE. So we should understand that this, and before that, going into it, it was trading in a high teens PE, which is kind of the era we've been in lately too. But we should be able to look and see that the market is willing to depress this stock price and hold it down for 6 years, right? So this last buy price kind of is designed to take that into account. If it looks like we're having one of these recession-like situations, maybe it's just a defense recession, because the government stopped spending money, then 256 is the price that would kind of mimic that era. So if it looks like that's what's going to happen before a person buys the stock, let's say it falls to 350 after some news comes out that earnings miss, or the government's not going to buy anything or whatever. I mean, who knows what it's going to be. But if you have that extra information and you're like, oh, this is going to be more like a recession type situation, even if it's not like a full-on economic recession, it could be just an industry recession. If in your mind you're like, okay, this is much more recession-y to me, then the $256 mark is, I have a whole other method that I come up with this number for, but I'm not going to, it would take like a 35-minute long video to go through it. But basically, I go back and look at, it's based on what type of pattern happened here and what earnings did and what people were willing to pay. Now, it's not a bottom picking price, even though it seems like it right now because it's so much lower than where the stock price trades. But what it does is it tries to get you to not buy so soon during this down cycle type process, right? So back then it peaked at like 120. You know, maybe it fell to like 75 and that looked like a great deal. You look at October 2008, the market was crashing. What it does is kind of gives you ballast so you realize that it could still fall lower, right, down. So it fell another like 25% after that. It tries to get you closer to the bottom so you're not buying too soon on the way down to one of these. Back then, earnings were steadier for these guys, so it's a little trickier here. They've been kind of choppy. We have, you know, this little bump up and now this decline. So it's a little tricky to kind of estimate it, but when I do my best to try to say, look, if we have a situation like that, when's a decent time to come in then? You could still come in, but more like at 256. So, and they're different. These first two are different methods than the next one, but they tend to go in like $50 increments. So, you know, about 350 is the more optimistic standard level, and then 300 is the kind of where I would lean probably right now, and then 250-ish is, you know, during if things are bad. So hopefully that helps everybody out. It gives you a range to kind of keep in mind. And these all have their own type of margin of safety in them. Like I said, earnings were less back in 2020. And I bought right around there, right around 320. So you can kind of see that that's still a lot cheaper than where the stock is now. And right now, earnings are actually lower than they were in 2020. So the stock can definitely go down more. And this was during like a stock market bubble. I mean, now this industry wasn't in a bubble, and like medical stocks and healthcare stocks weren't in a bubble. So I was buying them when everybody was buying, you know, meme stocks and GameStop and stuff like that. But so sometimes the market can just get kind of wonky either way. And there's a good chance we're just in the beginning stages of this sell-off. I mean, it doesn't seem to be super cheap to me yet. I mean, you get down to like the 350-ish, and then you're starting to at least, then it starts to get tempting to start easing in maybe. But it doesn't look super cheap to me. It looks fair value, honestly, right here. This is about fair value level, which isn't bad. It kind of depends on what situation you're in, how much money you want to try to get in the market. But I would definitely wait for a cheaper price personally, kind of given everything else that's going on. All right, if you found this useful, hit the like and subscribe button. I have a weekly picks over on Patreon for $25 a month. That's been doing really well. I also have a free tier over there. I post all the same videos I post here. Every now and then I post a little bonus, but I've been pretty busy. And there's a $5 tier if you would just want to request stocks and kind of get bumped up to the top of the list or get some immediate feedback from me in the chat room and stuff. A $5 a month tier is pretty good for that if you just want to kind of ease your way in and just get quicker responses from me. I usually respond really quickly to members. And then I also have a full Cyclical Investors Club over on Seeking Alpha. All right, everybody. Thanks for watching, and I'll see everybody later. Bye.